Hello and welcome. Today we will be discussing stocks. Stock is an ownership interest in a corporation and gives anyone who owns stock in a company a claim to a share of that company's earnings and assets. In essence, holders of stock or shareholders are partial owners of a company. The degree of ownership that a shareholder has depends on the number of shares that a person owns relative to the number of shares issued by the company. For example, if Michael owns 100 shares of Burgers & Buns, and Burgers & Buns has 1,000 shares of stock outstanding, then Michael has a claim to 10% of the earnings and assets of the company. However, if Michael owns 100 shares of Burgers & Buns, but the company has 2,000 rather than 1,000 shares of stock outstanding, then Michael only has a claim to 5% of the earnings and assets of Burgers & Buns. Now there are two main types of stock, common stock and preferred stock, and each have unique characteristics. Holders of common stock exercise their ownership stake by electing a board of directors and voting on corporate matters. They are at the bottom of the priority ladder of a corporation's corporate capital structure. What this means is that in the event of liquidation, common stockholders will be the last to be paid out a dividend. They will only be paid out the assets that they have a claim to after preferred stockholders, bondholders, and other claim holders have all been paid out in full. So, claims to ownership clearly do not amount to concrete entitlements for common stockholders. For this reason, common stock is considered riskier than debt or preferred stock. Yet because common stockholders are entitled to all of the profits of a corporation after it has met its obligations to debt, preferred, and other claim holders, common stock has the potential to provide greater returns than do either debt or preferred stock in the long run. On the other hand, preferred stock is a class of ownership in a corporation that is higher on the priority ladder of the corporate capital structure. The precise structure of preferred stock varies from corporation to corporation, but preferred stock generally includes a dividend that must be paid out before dividends to common stockholders are paid. This makes preferred stock less risky than common stock. However, unlike common shares, preferred shares include no voting rights in the normal course of business, and the rate of return from preferred stock is generally less than that from common stock. In summary, stocks are a type of security that represent an ownership interest in a corporation. The two main types of stock are common stock and preferred stock. Common stock is usually riskier because common stock dividends are paid out only after preferred stockholders and debt holders have been paid out. This represents a very real risk to capital. Preferred stock is comparatively less risky because it is higher up in the corporate capital claim structure. However, the returns offered by preferred shares are usually lower than those offered by common shares and are capped. Ultimately, it is up to the investor to determine which class of stock, common or preferred, is best suited to their purposes. Thanks for watching, and as always, if you have any further questions, please do not hesitate to give us a call or visit our website.